Rick Santelli, I imagine, is watching gold, some central banks, expectations of certain central banks in the days to come, Rick?
Well, I think central banks, when it comes to the Bank of Japan, it's definitely probably going to add more to their quiver in terms of arrows of quantitative easing. But what's love got to do with it really is the theme of this segment. And what I'm referring to is, Bob Pisani, in my opinion, coined one of the best expressions of the year with regard to equities. He said it's the most hated rally of all time. But, the same could be said for treasuries. Now, granted, if you look at where treasury yields were at the end of last year, they were around 186, 187. So we're at 182. We are still lower yield, higher price. That doesn't include, of course, the semi-annual interest payments, as meager as they are. But the point is, if you polled investors, or even more importantly, if you polled institutional fund managers in 2010, 2011, 2 weeks ago, what you'd find is every step along the way, they were bearish treasuries, whether yields were at 275, 250, 2.25%, 2%. And the only time they were slightly right, of course, was that small window where we were around 138 to 140, the all-time low closing yield. But the point of this is, as I've said all along, I don't believe investors are stupid. We all now know that flows haven't been in equities, they've been in bond funds. Or have they? Jim Bianco, one of my favorite economists, he wrote a wonderful paper, and I'm going to pull one quote out of it. It's called Everybody Hates Treasuries. And the quote is, "We do not see a big interest rate bet being made by the public. We see tax plays, we see currency bets, and big bets in corporate bonds, which can also be described as a low beta stock bet." So what is he really saying? What he's saying is, don't lump it all together. It isn't really an interest rate play. It's really a credit market play, and a lot of that, munis in particular, even with areas of California, potentially Illinois, around the country, these municipalities that are going Chapter 11, or Chapter 9, it doesn't really matter, because it is still a play maybe against the fiscal cliff, taxation. But the point is, there is something we all agree on, but be careful, okay? If this is 5 years, okay, on stocks, I think what everybody's thinking about is, between where we're at now and 5 years, they do believe stocks are going to be higher. But the real question is, where's the path to get there? And I think the same thing is true for interest rates. Here we are around 182. I think it's pretty smart to say that in a 5-year horizon, pretty much everybody agrees they're going to be higher. But what path are we going to take? That is really the argument. And when you get many of these managers that say, don't worry, just buy and hold, or buy on the dips, that all might be true, except for somewhere along the line, there's going to be an extreme that many want to avoid. But timing is nirvana, and it isn't easy. Back to you.